in the last 5 years, investors have been net sellers. Let's call it recycled silver. So they've been recycling silver to fill the gap. But as the amount of recycled silver becomes less, people become less willing to sell their silver. That's why the price has risen. Now, according to the Silver Institute, they're forecasting record purchases of silver by investors this year. Now, if that does in fact happen, there'll be no spare silver to meet the deficit because the above ground silver will be actually increasing as people buy that silver if that forecast is correct. So I think that based on those numbers, which are only speculation, because nobody really knows how investors are going to behave, but if the numbers are correct in the forecast, it does mean that the price of silver has to go higher.
The other chart that I think is interesting, Clive, is this. And that's why I'm so bullish. Commodities, not just gold and silver, but all the other commodities.
Silver's story is becoming harder to ignore as supply pressure, industrial demand, and investor behavior begin to collide. The market has already been in deficit for several years, with mine supply lower than it was a decade ago, while industrial use continues to rise. For years, recycled silver helped fill that gap, but that cushion may be shrinking as holders become less willing to sell. Innecco and Clive Thompson explained that if investor demand reaches the record levels now being forecast, the silver market could face an even tighter situation. In that case, there may be no spare above-ground silver available to cover the deficit, meaning the price would likely need to move higher. To illustrate these developments, they also point to China's strong silver imports and the premium for physical metal as signs that real demand is building. With that context in mind, we present the clips from their interview. Before we continue, make sure to like, share, and subscribe for more insights like this.
Gold and silver are down. Silver is down 80 cents at 74.60, the spot.
Yeah.
Gold is down 5 at $46.7. Yeah. But I'll show you the story here. I've got it here.
I mean, if I'm looking at the chart, it's still to me, in my mind, looks like gold is in a long-term uptrend.
Yeah, the same thing for silver. This is just a consolidation, in my opinion. So here you go, a margin on all four precious metals futures contracts being reduced. Gold, 14%, silver, 21.4%. You could argue that this might even help the shorts because they don't need as much money to short, but also vice versa. But I don't know. Anyway, I think you wrote something the other day, didn't you, about the fundamentals for silver? They still look really good.
Yeah, we've got about 4 or 5 years ago, the supply demand situation went into a deficit. And we're still in a situation, according to the Silver Institute, where the mined supply is less than it was 10 years ago. In other words, the mine supply has been falling year after year consistently, not every year, but more if you look on a 10-year basis, it's down. At the same time, the industrial production usage of silver is rising, and it crossed over where the industrial production or the usage exceeded the mine supply about 5 years ago. And that deficit has been growing wider. Now, the thing which nobody can completely predict is how investors are going to behave. So in the last 5 years, investors have been net sellers. Let's call it recycled silver. So they've been recycling silver to fill the gap. But as the amount of recycled silver becomes less, people become less willing to sell their silver. That's why the price has risen. Now, according to the Silver Institute, they're forecasting record purchases of silver by investors this year. Now, if that does in fact happen, there'll be no spare silver to meet the deficit because the above ground silver will be actually increasing as people buy that silver if that forecast is correct. So I think that based on those numbers, which are only speculation, because nobody really knows how investors are going to behave, but if the numbers are correct in the forecast, it does mean that the price of silver has to go higher.
Yeah, and look at this. It was Tavi Costa posted this the other day, or it came out. It's not only him, but China imports most silver ever in March. So, no wonder there's like a premium for silver in China. because I think they have the real physical price there. And the other chart that I think is interesting, Clive, is this. And that's why I'm so bullish. Commodities, not just gold and silver, but all the other commodities, real assets versus financial assets price relative, it's still like near the bottom of the last 100 years. I mean, and if you just get let's say 2 or 3% of all financial assets shift over into commodities, I mean the sky sky is the limit for commodities because they've produced so much paper assets, haven't they?
I think it will come. I think the money will move
Yeah.
into commodities. It's down to the asset managers to decide that they're going to include commodities as part of their asset allocation. The traditional 60-40 allocation continues with most asset managers. A small number are now putting gold in the portfolio, but
Yeah.
it's not a large amount. It's relatively small, 1 to maybe 5% in some cases. But the broader commodity sector should get an allocation too.
The deeper point is not just about silver alone. Mario Innecco and Clive Thompson connect the move in precious metals to a broader rotation from financial assets into real assets. Commodities remain historically cheap relative to paper assets, and even a small shift of capital from stocks and bonds into physical resources could trigger a major repricing. Clive notes that most asset managers still follow the traditional 60-40 portfolio model, with only small allocations to gold and even less attention given to the broader commodity sector. But that could change as inflation, debt growth, and currency weakness force investors to rethink what truly preserves purchasing power. Their view is clear: gold, silver, and commodities are not just short-term trades. They represent protection in a world where paper claims keep expanding while real resources remain limited. Let's get back to the interview.
Clive, let's changing subject, talking more about bonds now. You told me a story. I think it was your mom or someone in your family bought government bonds and they had a really bad experience and they bought it during the war or something. And the reason I'm talking about this is because last week this story came out that our chancellor, Rachel Reeves, she's thinking about war bonds to fund defense spending. And
Yeah.
why not just issue more gilts, right? Because she thinks that if they issue it as war bonds, people will be, they're pandering to people's patriotism and they're hoping that they don't have to, the government doesn't have to pay as much to borrow. And I think it's not going to work if you call it war bonds. People are still not going to, I wouldn't touch this with a barge pole. But what do you think?
Well, the story as it goes, and this is from what my mother told me, and it's about 40 years ago, so forgive me if the exact numbers are incorrect. But my grandfather, her mother, had bought what's called war bonds at some point. Everyone was encouraged to buy war bonds, so he'd invested in the war bonds. And at some point, they decided to consolidate all these war bond issues into a single issue, which became known as the consolidated debt, or otherwise known as consols. The trouble was, or the unfortunate thing was, the war bonds had a maturity date and they were supposed to be repaid after the war. But when they consolidated, they became perpetual, not only perpetual, but they also had a lower interest rate than the original issue. So here I'm making up numbers because I don't have the numbers, but let's say he invested in war bonds at 4.5% with a maturity in, let's say, 1947, for example. In fact, that became perpetual, no maturity, and that 4.5% became 2.5% because it became the consolidated debt. And those consols then, as perpetuals, eventually traded down to very, very low percentage of the initial amount. Because when they were issued effectively at 100, but as interest rates and inflation spiked in the UK in the 1970s, these consols would have gone down to prices probably below 20%.
Yeah.
But then, guess what? So people were buying and selling these things on the stock market as they would, but they were buying them at much lower prices than the original issue price. But then what happened? The interest rates in the UK effectively went almost to zero, and the perpetual bonds with a fixed interest rate, needless to say, rose in price higher and higher. So when you've got an interest rate of, let's call it 0.5%, a yield of 0.5%, but you have a perpetual coupon paying 2.5%, it's going to trade well above 100. So these bonds did go above 100, and guess what the government decided to do? They redeemed them at 100.
Yeah,
So
when
if you'd held them for 60
that like
70,
recently when rates were at zero, or
yes, it was about 5 or 7 years ago.
Yeah.
So if you'd held these bonds for the full sort of 70 or something years or 80 years that you had to hold, you would have got your money back. But along the way, you had an awful
your
journey.
grandparents, they weren't around 5-6 years ago, so yeah, they lost out.
That's right.
Yeah, what it means perpetuals for the viewers is that basically it never matures. So, like Clive said, it's almost like an infinity bond. So if inflation is really high, the price is very sensitive. So the same thing happened, Clive, in the U.S. World War One. I've spoken about this. They were also called victory bonds and stuff in 1917, and they used like celebrities to pitch them. And people bought them. And the problem with wars, Clive, is that, and I think it's going to be the same thing now. And I don't know if Europe wants to get into a war, but it looks like they're preparing for something. I don't know. But there's always inflation after a war. And in like after 1918, there was a massive inflation in the US, and most of the people who bought these bonds, they lost out. And then, do you know what happened as well, Clive? A lot of these bonds, they were gold backed, right? Because at the time, the US was under a gold standard. And there was one bond that was issued in 1918, a 15-year bond. So add 1918 to add 15 to 1918, you get 1933. What happened then?
World War II.
No, 1933. No.
Oh, 40, yeah.
FDR banned gold ownership.
Oh, yes, because they couldn't repay.
Any bond that the U.S. had issued that paid in gold, they didn't pay in gold anymore. So they defaulted on it. So never trust governments, and they're going to pander to your patriotism.
So, at the moment, I don't think, I mean, it's not just at the moment, but for quite a long time, I felt that investing in government bonds, you're not being paid a higher enough interest rate to compensate you for the generalized increase in money supply and government debt. Now, we've got government debt increasing by 5, 6, 7%, and you can't get that sort of yield on a bond. So you're basically, and if you're a taxpayer, you're even worse off. You're basically going backwards if you buy those things. You have to buy tangible assets. And as I showed you a bit earlier, we're seeing the price of tangible assets rise much faster than the official inflation rates.
Yeah, I mean, that's why I keep saying, having gold and silver or continue to stack is the way forward, because you can't print and create real things out of thin air. And with the world becoming deglobalized now, and China having taken over so many of these critical minerals, and it was partly the West's fault, because the West is still focusing, Clive, or maybe it's changing a bit now. They've realized, but it's a little late. We're focused on financialization, credit, consumption, and we've forgotten that you need real things, even for technology. So I think that's the big play for the next 5-10 years. It's going to be how commodities are going to outperform the financial assets or paper assets.
Mario Innecco and Clive Thompson also warn that government bonds may no longer offer the safety many investors assume. Their discussion of war bonds shows how governments can appeal to patriotism while shifting long-term financial risk onto ordinary people. Bonds may promise stability, but when inflation rises, purchasing power can be quietly destroyed. Clive argues that investors are often not being paid enough interest to compensate for rising government debt, expanding money supply, and long-term currency weakness. If debt is growing faster than the yield investors receive, bondholders may be going backward in real terms. That is why tangible assets become more important. Mario adds that the world is moving through deglobalization, resource competition, and a renewed focus on critical minerals. The West spent years prioritizing financialization, credit, and consumption, while real assets and production capacity became increasingly important. Their prediction is that over the next 5 to 10 years, commodities could outperform paper assets as investors rediscover the value of things that cannot be printed. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.